We've got lots more on the Bank of Canada rate decision, and we are joined by Andrew Kelvin, Head of Canadian and Global Rate Strategy at TD Securities. Andrew, thanks very much indeed for joining us this morning. You haven't had long to go through these comments from the Bank of Canada. Anything jumping out for you, though?
Yeah, thank you for having me. I think what the Bank of Canada was trying to do here was push back on some of the maybe more excitable interpretations of the recent Canadian economic data. After that jobs number, people were starting to talk about potentially the Bank of Canada hiking rates, as early as 2026. I think what the bank was trying to do, while signaling that the economy does remain resilient, perhaps a little bit better than expected, there are challenges ahead with the USMCA renegotiation next year. Additionally, there is still slack in the economy. So I think what the bank was trying to do is say, well, they are still very comfortable with where interest rates are. They have no buyer's remorse around the last batch of rate cuts, and just trying to remind everyone that there are still challenges ahead.
Do you think there was, I won't call it euphoria, but maybe some unwarranted optimism creeping in about the Canadian economy after those strong job figures?
I think so, if only because Canadian jobs data is notoriously volatile. There are still challenges ahead. If you look at the Q3 GDP data, well, it was quite a bit stronger than expected, about 2.5%, 2.6% annualized growth. Consumption activity was quite soft in the third quarter. And this is an economy that has some catching up to do. Even with the unemployment rate falling quite sharply after that last jobs report, 6.5% still a higher unemployment rate than Bank of Canada would probably like to see.
The Canadian dollar slipped. I know you're not you watch currencies very, very closely. Canadian dollar slipped initially after the announcement. It has come back a bit, but why? Could you suggest a reason why our currency would have weakened after the Bank of Canada stood pat like that?
Yeah, absolutely. We actually saw a similar move in short-term interest rates, short-term bond yields. There were subsets of the investor community that had been looking at recent Canadian data and was starting to position for the idea that the Bank of Canada may have to start moving rates higher much more quickly than anticipated. Markets are pricing in rate hikes for late in 2026. And because markets are sort of an opinion weighting machine, there would have been individuals in there who would have been positioning for moves quite a bit more quickly. Those individuals would have found themselves disappointed by the fact that the Bank of Canada is not panicking after 1 or 2 months of very strong data.
And actually, Andrew, you may have touched on this, I'm sorry, but what is your shop? What is your view on the next rate hikes from the Bank of Canada? Are they possible in late 2026?
So our expectation is for the Bank of Canada to lift rates in January of 2027, so early 2027. Okay. Now, you're always going to have a confidence band around a forecast 12 months into the future. As we saw in 2025, a lot can happen in 12 months. So is late 2026 plausible? I think it is, if fiscal stimulus is effective in really driving growth. At the same time, if we see USMCA renegotiations to produce a lot of uncertainty for our business sector, to really impact hiring, really impact investment, it's easy to see the next move pushed into later in 2027. And we can't completely rule out cuts here either if things do take a turn for the worse in the early part of next year.
I suppose a big imponderable often for any economist is confidence in the economy, and it involves psychology. And that obviously is a big part of the lack of business investment we've seen, which our economy needs.
That's a big part of it, although I would say business investment in Canada has been quite low for really decades, particularly if you exclude the energy sector, which I think masked a lot of issues around business investment in the non-energy sector, call it 10 to 20 years ago. So confidence is important. It's important to create a business-friendly environment, which is, I think, what the government was trying to do with this most recent budget. Time will judge if they were successful in achieving that. But the lack of business investment in Canada has been a long-standing issue, and you are quite right to suggest it is something the economy really does need.
What are we going to do? I mean, would one approach be just to try to drive down our currency so that we're seen globally as a cheap place to open a manufacturing plant?
I don't think so, because if you look at the performance of the Canadian manufacturing sector over the last 25 years, we've seen very little growth in non-energy exports in Canada going back to the year 2000. That encompasses periods where the Canadian dollar was quite rich versus US dollar, around parity, above parity even, and it includes periods where the Canadian dollar was quite weak. So I think on the basis of evidence over the last 25 years, simply weakening the dollar isn't in and of itself going to be enough to promote manufacturing and business investment in Canada.
I mean, is money, well, obviously a lot of capital in Canada has been diverted to residential housing. Some, I think, argue excessively, even though we still have a housing shortage. Is that part of the problem, that money should have gone into more productive stuff, such as factories?
It's an interesting question because, to your point, we do still have a housing shortage. Like, Canada hasn't done a good enough job at building housing over the last decade or so either. So I think if you want to look at the common thread, we haven't done a good enough job at building housing. We haven't done a good enough job promoting business investment. I think you could probably look at those two things and logically conclude that perhaps we haven't been a friendly enough environment for investment. And I think the task of governments in the future is to try and, or one of the tasks, I should say, it's not the only task, but one of the tasks should be to try and make Canada a bit more of an attractive place to invest.
Always great to hear from you. Thanks very much, Andrew.
Thanks for having me. Always a pleasure. Have a good day.
You too. Andrew Kelvin, Head of Canadian and Global Rate Strategy at TD Securities.